It's the first trading session of February, and markets are worrying about fresh manufacturing data out of China. I'm joined now by Simon Smith, the chief economist at FxPro in London. And Simon, China's manufacturing sector now declining for the sixth month in a row.
Yeah, the ISM data, or the manufacturing PMI data we had overnight, was telling us what we probably already knew. There are a lot of different ones you get in China, but the message is that it's slowing, and we know that. And of course, with these indices, there are always a bit of relating them to the real economy is not always easy. The fact it's below 50 shows, the pace is slowing. But still, the Chinese economy is performing, if you believe the statistics, relatively well versus others. So and the markets were not that bothered about it. We've seen a steady-ish open, but still, nevertheless, it confirms the background that the Chinese economy is slowing.
This was one of the factors about a month ago at this time that caused stocks to have their worst start to a new year ever.
It was, and I think if we go back to that time, and if you look at the difference, it wasn't a major miss we had on that PMI, but nevertheless, a lot of things, it can just be the catalyst that causes markets to change mood. So it's difficult to sort of, if you look at the two events in isolation, you think, well, this doesn't make sense. We saw a big reaction in January. We get the same numbers in February, but barely get a ripple. But I think a lot of other factors were combining early in January in terms of market sentiment to cause that change, not least that we'd entered into a sort of new trading month and year.
Now, of course, we saw a rally in stocks last week amid central bank action. Is future hope from the central bank via stimulus, whether it's the European Central Bank or a delayed rate hike from the Federal Reserve, is that what is going to keep these markets stable in the coming months?
It's difficult because if you look, we've been in various forms of quantitative easing, in leaving aside Japan since 2009. We're now in 2016. So hoping that central banks are going to prop up markets is becoming harder and harder, and as asset prices become more misaligned as well. So I think it's a dangerous thing to lean on, the hope that actually we're going to get more stimulus from central banks. Therefore, markets will at best stabilise, if not move higher. And we're in a very different environment from what even we could consider 2 or 3 years ago. So I think it worries me that if we're sort of pinning our hopes on that in terms of market stabilisation, it's not as comforting as it would have been at least 2 years ago.
All right, let's talk about oil prices falling again after it appears that OPEC won't be cutting production, contrary to reports saying otherwise last week. What's your take on where oil is going?
The oil price is, I think, going to head lower on the big picture. The dynamics of the way we think about oil have changed massively in the last few years. The whole, a few years ago, we were worrying about oil running out. Now things are very different. The US has ramped up its production. The whole economics of oil has changed. Energy efficiency is getting stronger. People are using alternatives to oil, and that's been building up in the last few years as well. So we have Iran coming along as well, one of the, I think, the fourth largest in terms of proven reserves. So a lot of things are happening in the oil market, which means, I think, looking ahead, that this is going to be at best a year in which oil prices remain around current levels in the sort of lower 30s handle. More likely as we see a sustained move down to the 20s, which has big implications in terms of inflation, central bank action, also currencies as well. There's commodity currencies. So I think lower oil prices are going to remain a feature of 2016.
All right, Simon Smith, the chief economist at FxPro in London. Simon, thanks very much for your time. I'm Scott Gamm, and you're watching The Street.